existing portfolio with a target portfolio, rolling return and drawdown analysis of existing and target portfolio, and also generating actionable PDF report, which can act as a proposal to the client. And at the end, the forum will be open for a Q&A session. So this is our NGEN Markets landing page. Firstly, we'll be seeing what are the multiple ways in which you can onboard a prospective client. So for that, we'll be heading towards the Clients tab, which is the third last tab on the platform. So once you click on the Clients tab, this is the landing page, which is basically the RTA connection wherein you can onboard your existing client. Now for prospective client, let us say that your client has provided you with an eCash statement. So for that, you will move towards the Statement Analyzer tab, which is right above the RTA connection option. So once you click on Statement Analyzer, you can load NSDL, CDSL, and CAM's eCash statement, which is in the PDF format. Also, please ensure that these PDFs are not modified. So now to load this eCash statement, all you have to do is click on Choose File and select the eCash that you want to upload. Now, all you have to do is fill the password. That is basically the PAN number. And then you just have to click on Check File. It comes up with a prompt stating that it is a recognized file type. Now you can also add a label which is completely optional. So let us say that this is a client, a prospective client for the month of July. So we will give it a label as July prospect. And then all you have to do is click on Process and Save File. So it will take 30 seconds to load, and once it gets saved, you will be able to see it on the right-hand side. So here you can see with the label July prospect, the name of the client, that is Smith Agarwal, and you can also see the date and the time as to when it was uploaded. Now you can also generate a report for this eCash. So for that, all you have to do is click on this report icon, which is right here. So once you click this, you will be able to see what are the holding towards the funds, as well as what are the holding towards the stocks as well. Now let us say that you want to load this particular eCash statement in the portfolio section for further analysis. So what you have to do is go back to the NGEN Markets platform and move towards the portfolio tab, which is the second last tab. So once you click on portfolios, all you have to do is click on this plus icon which states add a new portfolio. So once you click on this plus icon, you can see that there is an option to load the statement analyzer. So once you click on load statement analyzer, then all you have to do is click on this plus icon. So once you click on the plus icon, you can see the holdings of that particular eCash. Now you can see a bar chart like icon right here, which basically stands for stock holding. And you can also see a bag icon with a dollar sign, which basically stands for fund holding. So you can also give this particular folder a name. Now this is Smith Agarwal. You can completely edit this. Also, you can select the folder wherein you want this particular file to appear. So right now, the active is the folder that it will appear upon. You can anytime run this particular eCash for a detailed analysis. But in order to save this in your login, you firstly have to click on this option that is create. So once you click on create, it will get saved in the portfolio section itself. So as we were able to see, the active folder is something that you would be able to see this particular portfolio in. So you just have to click on this plus icon and you can see that Smith Agarwal's portfolio is right here. And once you click on this drop down and run, it will load a detailed analysis for the same. Now, the second way is, let us say that your client has provided you with the details of ISIN and holdings. Under that situation, what you can do is in the portfolio tab itself, there's this plus icon which states add a new portfolio. So once you click on this plus icon, you can see this option to load ISIN from Excel. Once you click, there are two basic details that you're required to copy and paste it right here. The first column should be ISIN and second column should be holding, which can be either in terms of percentage or in terms of amount or in terms of units. So there's this percentage example. So as you can see, the first column consists of ISIN and second column consists of holding, which is in terms of percentage. Now you will also let the system know the reading of the holdings. By default, amount is being selected. So I will click on the drop down and select percentage, and I will click on validate input. Once this is done, you can see the holdings that are towards mutual funds and that are towards stocks. Now let us give this portfolio a name, that is July portfolio 2024. And again, you have the flexibility to select the folder wherein you want this to appear. And once again, when you click on create, it will get saved in your login. And again, you would be able to see that it will get saved in the active folder, which is right here. So once you click on this plus icon, you can see the July portfolio 2024 with current date and time is something that is loaded right here. Anytime you can click on this drop down and then select run. A detailed analysis for the portfolio is something that you can do right here. Now, these were the multiple ways to onboard a prospective client's portfolio. Now, let us move towards the core topic, that is how to compare two portfolios. Now, there are two ways to move towards the compare two portfolios tab. The very first is in the portfolios tab itself. On the top, you can see a weighing machine icon which states compare to portfolio. Once you click on this icon, it will load a page for the purpose of comparison. In the portfolio one, you can load your existing client's portfolio or prospective client's existing portfolio. And in portfolio two, you can load a target or a model portfolio that you want to pitch to your client. The second way of moving towards compare portfolios tab is in the compares tab itself. So once you click on the compares tab, this is the landing page that it will take you to. So basically herein you can conduct a detailed analysis for funds or stocks. Now, right beside compare securities option is compare portfolios option. So once you click on compare portfolios, it will take you to the same page. Now, let us compare two portfolios. Now, on the left-hand side, I will first load the portfolio of the client that we have onboarded using the ECAS. That is Smith Agarwal. And in portfolio 2, I will load a target portfolio that I want to pitch to the client. Now, anytime you can custom your own start date. So let us analyze this for the period of 2021 starting from 1st July. And once you click on go, the detail accordingly gets loaded. Now, as you're able to see that this particular portfolio of Smith Agarwal is made up of mutual funds and stocks. So there are total 18 components in this particular portfolio, whereas the target portfolio that we have loaded consists of 7 mutual funds. Now let us take certain parameters into consideration for comparing the portfolio of Smith Agarwal and target portfolio. Now, the very first parameter that we'll take under consideration is the average annual return. So average annual return is basically the average of year on year that is being generated. Now here you can see that Smith Agarwal's portfolio has average annual return of about 22.68%, whereas target portfolio has an average annual return of about 23%, which means excess of 0.34% is being generated by target portfolio in comparison to Smith Agarwal's portfolio, which is the existing portfolio, or you can say prospective client's existing portfolio. Then second parameter that we can take under consideration is Sharpe ratio. Now, Sharpe ratio is risk adjusted return. It tells us how well the portfolio is performing in comparison to the risk that it is taking. Now here we can see that Smith Agarwal's portfolio has a Sharpe ratio of about 1.04, whereas target portfolio has Sharpe ratio of 1.20, which means excess of 0.16 point has been generated by target portfolio in comparison to Smith Agarwal's portfolio. So higher the Sharpe ratio, the better it is. So we can clearly see this, the target portfolio has a higher Sharpe ratio. Now, this was a portfolio that had a mixture of stocks and mutual fund, which was being compared to the target portfolio. Now, let us compare a direct equity portfolio with target portfolio. Now, direct equity portfolio consists of all the stocks. So, let us replace Smith Agarwal's portfolio with a direct or a stock-based portfolio. So here you can see in stock portfolios, there are total 16 stocks, which is being compared with a target portfolio having 7 mutual funds. Now let us take two parameters here for the purpose of comparison. First, we'll be looking into cumulative return, which is absolute or point-to-point return. Here you can see that stocks portfolio has a cumulative return of about 67%, whereas target portfolio has a cumulative return of about 89% considering the period. That is a 3-year period starting from 1st June 2021 to 25th July 2024. That is 1st July 2024 till 25th July, considering 3 years period. So we can see additional 22.17% of cumulative return is being generated by a target portfolio, which is purely mutual fund based portfolio. The second parameter is the annual volatility. Now, annual volatility is the measure of standard deviation, basically indicating about the risk. So here we can see that stocks portfolio has the annual volatility of about 16%, whereas target portfolio has a lesser volatility, that is about 12%. So we can clearly see that with a lesser volatility, the target portfolio is able to generate a higher cumulative return. So until now, we have compared a mixture of stock and mutual fund based portfolio with target portfolio. Then we have now just compared direct equity, that is stock based portfolio, with purely mutual fund based portfolio. Now let us compare a prospective client's existing portfolio that they might have created by themselves or as per a suggestion of other distributor, which is purely mutual fund based. So I'll be loading a prospective client's existing portfolio on the left-hand side, comparing it with the target portfolio. So here we can see.
Hello.
Yes. Can we take
Hi.
all the questions towards the end?
Okay. Cool.
All right.
Thank you.
Thank you.
Now here we can see that existing portfolio, which is a purely mutual fund based portfolio, consists of 8 funds, whereas target portfolio, which is again purely mutual fund based, consists of only 7 funds. Now this is being compared against each other. Now this blue line here represents the target portfolio, whereas the purple line right here, it represents the existing portfolio. You can see that target portfolio is clearly outperforming the existing portfolio. Now let us take certain parameters under consideration, and basically for the purpose of comparing existing portfolio and target portfolio, along with the differentials that are mentioned in the very last column right here. Now first is month to date, which is basically from start of the month till date, what is the return that is being generated. That is from 1st July 2024 till 5th July 2024, what is the return that each of these portfolios were able to generate. So we can see existing portfolio MTD is about 1.37%, whereas target portfolios MTD is about 1.17%. So the differential comes up to 0.20%. Now let us understand how did we derive to this MTD. Now for the purpose of calculation of MTD, we have taken the end price, that is the latest price, as you can see right here, which is 188.84, and it is being divided by the 1st July's NAV, that is the previous month's closing NAV. Now to check this, we can see that as on 25th July, this was the NAV, which is being divided with exactly 1 month prior, that is 28th July 2024. That is the closing NAV. So once it is divided and we have subtracted it by 1 for the purpose of percentage-wise calculation, it comes up to 1.17%, as we were able to see in the portfolio as well. Now next is YTD. So YTD stands for from the start of the year till date, what is the return that is being generated. So that is from 1st Jan 2024 till 25th July 2024, what is the return that existing and target portfolio has generated. So we can see that existing portfolio has generated a return of about 14%, whereas target portfolio has generated a return of about 22%, which means there is excess of 7.35% YTD return generated by target portfolio over and above the existing portfolio. Now let us understand the calculation for the same. Now for YTD, again, we have taken the latest NAV and previous year's closing NAV. So to check this, as we were able to see the end price, that is the latest price was about 118.84, as I've mentioned on the top in green. Let us see what was the NAV of the portfolio, that is the previous year's closing NAV. So this was the NAV of 29th December 2023, which is exactly 1 year, that is 1st Jan, which was about 155.09. So dividing it by 1, subtracting it by 1 again, which is basically the percentage-wise calculation for the same. Next is 1 year return. So 1 year return is basically point-to-point return that has been given as per the latest 1 year, that is considering exactly 1 year prior to today's date. That is today's 25th July 2024. So 1 year prior would be 25th July 2023. So this 1 year calculation, that is point-to-point return of the latest 1 year considering calendar days, is something that is calculated right here. So we can see 1 year return of existing portfolio was about 25%, whereas target portfolio has a return of about 40%, which means excess of 15% of the return was generated by target portfolio, again over and above the existing portfolio. Now let us understand the calculation for the same. So for 1 year, we have taken the latest price as well as the price of exactly 1 year prior. And as we can see right here, the end price was again 188. 1 year prior would be that is 25th July 2023. Exactly 1 year prior is 135.36. Now similarly is for 3 years return. So from 25th July 2024, 3 years prior would be 25th July 2021, somewhere near about 25th July 2021. So this is the percentage for 3 years, that is 22.37%. Now here we can see again the latest price, that is 188.84, which comes up to exactly 3 years prior. That would be somewhere around 102.87. Now 23rd July, because around 25th July 2021, it was Sunday. That is the reason we have taken under consideration 23rd July 2021 NAV. So again, the calculation, it comes up to 22.37%. Next is cumulative return. Again, the absolute return. We can see that the cumulative return of existing portfolio is about 50%, whereas target portfolio's cumulative return is about 89%, which means excess of 39% of the return was generated by target portfolio in comparison to existing portfolio. Now, to understand the calculation of cumulative return, we'll head back and we can see that it is basically the division of the end price, that is latest NAV, with the very initial NAV, that is 100, that was on 1st July 2021. And when you subtract it by 1, basically for the percentage wise calculation, it comes up to 88.85%. Next is volatility. So volatility, as mentioned earlier, is the measure of standard deviation, which is basically risk. So everywhere in the platform where you see standard deviation, it is annualized. So we can see the standard deviation or the volatility of our existing portfolio is about 8%, whereas target portfolio has an annual volatility of about 12%. But we can see, though it is taking a higher risk or the volatility is higher, still the cumulative return generated by target portfolio is also higher in comparison to the existing portfolio. That is the reason the Sharpe ratio is also higher for target portfolio. So higher the Sharpe ratio, the better it is. So we can see target portfolio has a Sharpe ratio of 1.20, whereas existing portfolio has a Sharpe ratio of about 0.74, which means additional of 0.46 point is being generated by target portfolio. Now let us understand the calculation for Sharpe ratio and volatility. So volatility is basically the standard deviation of the returns that we have calculated right here. That is the percentage wise return, which is multiplied by square root of 260 because taking under consideration that it is annualized. So it comes up to 11.89. And next is a Sharpe ratio. So how Sharpe ratio is calculated? For numerator, we have subtracted risk-free return with annualized return of the portfolio, and it is divided by annual volatility. So it comes up to 1.20, which is taking under consideration the risk-free rate, that is government bond 10-year rate. So it is about 7.08%. Next is average day, which is basically the average daily return that each of these portfolio are generating. So existing portfolio has average daily return of 0.05%, whereas target portfolio has an average daily return of 0.08%, which means excess of 0.03%. Next is average month return, which is basically average monthly return that is being generated. So existing portfolio generates average monthly return of about 1.12%, whereas target portfolio generates average monthly return of about 1.78%. Next is average yearly return, which stands for average year. We can see that excess return is being generated, that is about 16.64%, which is excess by 6.13% in comparison to the existing portfolio, generating an average yearly return of only about 10.32%. Now let us understand up months and down months. So basically, for the time period under consideration, that is 1st July 2021 till 25th July 2024, there are total 37 months. So once you add 25 plus 12 or 27 plus 10, it comes up to 37. Now, up month stands for number of months these portfolios were able to generate positive return. And down month stands for number of months these months were generating negative return. So now let us have a look at up months. So out of 37 months, that is 25 plus 12 or 27 plus 10, out of 37 months, 25 such months were there wherein existing portfolio was generating a positive return or return above 0%. Whereas target portfolio is having 27 such months wherein it was performing well, or you can say generating a positive return. So there was excess of 2 months by target portfolio wherein it was performing better than the existing portfolio. Next, what do we have is down month, basically indicating number of months it was generating negative return. So there were 12 such months wherein existing portfolio was generating negative return or return above below 0%. And target portfolio, there were 10 such months wherein the portfolio was, that is the target portfolio was generating a negative return, that is again below 0%. So we can see that there were 2 such months when it was doing better than the existing portfolio. Now let us understand and try to spot where were these months wherein it was generating a good return or return which was negative. So for that, we'll head towards the portfolios tab and load in this target portfolio. And once you click on run, it gets loaded. Please ensure that you load the correct portfolio, as well as also change the start date. So the start date that we have selected was 2021, 1st July. In performance tab itself, once you scroll down, you can see this monthly statistics. So you can see that there were total 37 such months, and out of 37 months, 27 months were such wherein the portfolio was doing well, and 10 such months wherein it was generating a negative return. So here we can see the best return that it has generated was about 7.77%, whereas the worst return that it has generated was about 4.06%, which is negative. Now let us try to plot this in which particular month it was doing so. So there's this bar chart representation, as you can see. So we'll just drag and check. So it was the month of July 2020, wherein the best return 2022, wherein the best return of 7.77% was generated. And exactly 1 month prior to it, that is June 2022, the negative return of about 4.06% was being generated. Next is down years. Now here you can see that there were no such year wherein both of these portfolios were generating negative return. This you can also cross verify by checking this particular graph. As you can see that though existing portfolio, this particular bar chart, though existing portfolio was underperforming the target portfolio, but it has never generated a negative return as such. Now let us understand correlation. So correlation tells us how related are the two portfolios in terms of their NAV movement. Now here you can see that the correlation is quite high, which is about 0.96. So what does this indicate? It basically indicates that the target portfolio, as you can see right here, the target portfolio is not very different from the existing portfolio based upon the asset allocation. Now we can check that through the second tab, that is asset allocation tab. So once you click on asset allocation, you can see that what is the allocation that is being made towards equity. So for existing portfolio, 70% is being allocated towards equity and remaining 30% is being allocated towards debt. There is this black line that is dividing the data of existing portfolio in comparison to the target portfolio. So we can see for target portfolio, about 82% is being allocated towards equity and remaining 18% is being allocated towards debt. You can also see what is the allocation that is being made in different sectors by each of these portfolios. So we can see that highest allocation is towards bank for both of these portfolios. And the second highest allocation by existing portfolio is towards IT, that is about 5.46%. And for target portfolio, the highest allocation is towards pharmaceutical, that is about 6.21%. You can also have an analysis for the debt as well. So here we can see for existing portfolio, the average YTM is about 7.30%. Whereas for target portfolio, the average YTM is about 7.20%. Also, you can check average maturity and average duration for both target and the existing portfolio. So for existing portfolio, we can see that average maturity is about 4.04 years, whereas average duration is about 1.66 years. In comparison to the target portfolio, it is having an average maturity of only about 1.29 years and average duration of about 0.64 years, which basically means that it is less risky. So higher the maturity, higher is the risk, and lesser the duration of the maturity, lesser is the risk. So we can see that the target portfolio is lesser risky in comparison to the prospective client's existing portfolio. With respect to debt, now if you want to check what are the underlying of the stocks in terms of the sector wise, what is the underlying of the sector, as you can see right here, for that you just have to move towards the exposure tab, which is the third tab right here. So once you click on exposure, you can see that for both the existing portfolio as well as the target portfolio, the highest allocation is towards HDFC Bank, about 4.77% by existing and about 5.64% by target portfolio. Similarly, you can also check the market cap exposure as well. So highest allocation by existing is towards the large cap, that is about 49%. Towards mid cap, it is about 13%, and towards small cap, it is about 7.6%. The other basically consists of debt as an asset class, as we were able to see in the asset allocation, that is about 30%. Similarly, for target portfolio also, we can check the market exposure. So here in again, the highest allocation is towards large cap, about 45.9%. And the second highest allocation is towards mid cap, which is about 28%. And towards small cap, the allocation made is about 8%. The others, including debt, is about 17 to 18%, as we were able to see earlier. Next, let us understand the rolling returns. Now, rolling returns tells us about the consistency of the portfolio. Now here, you can see the data for 260 days and 130 days. Now, 260 days stands for 1 year working period, whereas 130 days stands for 6 months. Now, let us analyze the rolling return for 260 days of the existing portfolio with that of the target portfolio. The very first is average, which is basically the average rolling return that has been generated by existing and target portfolio. Now, for 1 year, we can see that average rolling return is about 10.98% for existing, and for target, it is about 18%. Next is the highest return that is being generated. So highest return generated by existing portfolio is about 25.54%. Whereas target portfolio's highest return is about 37.29%. Next is low, which is basically the negative return generated by each of these portfolios for the period of 1 year. We can see that negative return is about 2.97%. And here for 260 days low return, we can see is about 0.68, and it is still positive. So the low is also positive, as we are able to see right here. Now let us try to plot this on graph and check in which particular month it was generating the highest return. So we can see at around 28th March 2024, the highest return was being generated. So if the investor would have stayed invested exactly 260 days prior to this particular date, he would have been the luckiest to generate or to earn this return of 25.54%. if it was existing portfolio. Now let us check the same for target portfolio and see in which particular month it was able to generate this particular highest return. So we can see about 37.29% being generated on 9th July 2024. So what we can see is if the investor would have stayed invested 260 days prior to this particular date, he would have been the luckiest to earn the highest return of about 37.29% when we talk about the target portfolio. And the average is basically the green line that you can see is the data points is considered to be the average, which is right here. So for existing portfolio, considering the data points, the average rolling return is about 10.98, and for target portfolio, as you can see, the average considering the data points of the green line is about 18.29%. Next is drawdown analysis. Now drawdown tells us the strength of the portfolio to recover from the loss. Now this gray line or the gray area right here, it represents the loss period, whereas the white area represents the recovery period. Now for existing portfolio, we can see that the worst loss was about 11.88%, which was between 18th October 2021 till 17th June 2022. And it took 118 days to recover. Whereas the worst drawdown that the target portfolio was facing was about 13.97%. That is the loss, which is the negative return of 13.97%, which was between 17th Jan 2022 till 20th June 2022. And it took only 55 days to recover. So we can see, though it was taking a higher loss or facing a higher negative return, still it took only 55 days to recover. Whereas the existing portfolio took more than 100 days to recover from the loss of 12%. So again, we can conclude that the target portfolio is able to recover faster from the loss that it is facing in comparison to the existing portfolio. Now let us understand what are the reporting options in this particular tab that is being provided. So there's this PDF option that is being provided on the top left side, as you can see. Now you can generate a capital-based PDF report. If, for example, let us say your client wants to invest an amount of 50 lakhs. So you just have to enter 50 lakh as a capital and then click on go. So once you click on go, a PDF report will be generated. So this PDF report, basically all our PDFs and PPTs on the platform comes with co-branding. So on the left-hand side, instead of our company's name and logo, you would be able to see your company's name and logo right here. So all the analysis that we were able to do on the platform is something that will be generated in PDF format as well. So you can see the performance statistics, the parameters that we have taken under consideration for comparison, the differentials mentioned at the very end, as well as the asset allocation of existing and target portfolio, the sector-wise exposure, market cap allocation, and what was the rolling return of existing portfolio and target portfolio. And the last page, as you can see, the capital amount that we have entered of about 50 lakh is being allocated among the different funds based upon the allocation, the percentage-wise allocation that was made. So this can act as a proposal to your client, letting them know what is the amount that was being invested in the existing portfolio if they would have if the investment would have been such, and what is the amount based allocation made in the different fund based upon the target portfolio or the portfolio that you want to pitch to your client, making them switch from the existing portfolio towards a new portfolio. So thank you, everyone. This is it for today's webinar's topic. In case if you have any kind of queries, the forum is now open for a Q&A.
Yes, sure. So there's a question in the chat box asking, can we get a recording of this particular session? Sure. So all the webinars recording will be available on our YouTube channel. That can be located right here at the top. And you can definitely find the recording of all our previous webinar recordings. This week's webinar recording will also be uploaded by next week. So you can see that in a dedicated playlist channel for webinars. Any more questions? Please let us know.
I think if there is no more questions, Prajakta, if you can wind up, please.
Yes. So thank you so much for joining in. As mentioned, you can definitely check the webinar recordings from our YouTube channel. So we will definitely come up with a new and interesting topic next week. Till then, do stay tuned. And thank you, everyone. Have a very happy weekend ahead. Thank you.